Welcome to Mentoring Moments. Mentoring Moments is a sub-series of the E-commerce Edge podcast. It is composed of clips taken from Jason's one-to-one and group mentorship sessions. Hello, everybody, and welcome to another episode of the E-commerce Edge podcast. Now, before I welcome our next guest who's here to talk about some things that I am definitely not an expert in, and that's one of the reasons I love having a podcast, because I get to talk with people that are experts in stuff that I don't know much about, and I definitely am not the guru on. But what I would suggest you do so that you don't miss a single episode is whatever podcast channel you're listening on, go ahead and hit that follow or subscribe button. We've got a back catalog of over 425 episodes now, so a pretty deep catalog of amazing content all about e-commerce, omnichannel, and digital retail. But without further ado, I would love to welcome, and I'm sure I'm going to butcher this name. I did test it out beforehand. KUDEREWSKI from WebStreet. Welcome to the pod.
Very good. Thanks for having me. A+.
Did I get it close?
Very close.
Okay, good stuff. Good stuff. Listen, this is, I love getting guest mentors on for our Monday episodes, mainly because this is a broader-based forum. So Wednesdays, B2B episodes, Friday, tech-focused episodes, but Monday, it's a little bit more of a free-for-all. And I love that because I get to talk about topics that are either directly related or even tangentially related to the e-commerce or digital asset space. And this is where I think somebody like you really can come in and add some color, some flavor to the conversation. And before we get into what WebStreet does, and how it even came to be, how did you get into this wonderful, crazy world of e-com, digital assets, digital asset investing, digital asset classes, digital real estate, for lack of a better term? How did you even come to be in this space?
Sure. Yeah. So starting out, I just want to say I love mentorships. I take mentorship very seriously in my own life. Finding mentors, I don't know that I'll have all the answers, but if I can help somebody just a little bit, then our time will be well spent. I got into this space through physical real estate and through investing. Going too far down the weeds, my background is in engineering. I went to engineering school, did my master's, corporate America role, really good kind of foundational start to life. But I knew I wanted to get outside of the W-2 and bet on myself and also just invest in my financial future. So I got really educated in all types of asset classes, and I was close to purchasing a few online businesses, learned about the industry, ended up going the real estate route in the beginning. I still own some vacation rentals here on the East Coast of the United States, mostly passive now, which has been a blessing. But I still always kept an eye on the online space, digital assets, digital real estate, if you will, and still very bullish on the space. And that's what led me to WebStreet.
And you are now the ops manager of WebStreet. And we were talking about off air that you were the very first employee of WebStreet. And so let's call you a founding team member of WebStreet. You've been doing this for 3.5 years now. And how did WebStreet come to be as an organization, as a business, as an acquirer and operator of brands, as I understand it now? In full transparency, I've never worked with WebStreet before, so I have to go by what's on the tin, what's on the website. But as I understand it, you acquire and help to operate cash-flowing e-commerce brands, and then you surface those to accredited investors so that they can invest in these assets as a part of their investment diversification plan. How can they, because we've all heard of ETFs, we've all heard of mutual funds, we've all heard of physical assets, golds and silvers and precious metals, and we've heard of investing in real estate and having a diverse portfolio of shares and bonds, et cetera, et cetera. I invest in the public markets. I hold some private assets. I own some real estate. So I understand the value of diversification. But I think, at least as I see it, and this is somebody who's been in the e-commerce space for over 24 years now, I think that a lot of investors, even those that might operate in the VC or PE world, oftentimes they're a little bit afraid of investing in assets they don't know much about. And there's a lot of people out there, there's a lot of investors out there that don't know anything about the online world. They don't know how to vet an investment in the online world. They don't know how to decide what percentage of my overall portfolio should be invested in this asset class. What are the average returns of this asset class? What are the risks? What are the opportunities? Should I invest domestically, internationally? It feels it's a fraught asset class in the sense of it is not as mainstream as logging into your brokerage account and buying an ETF. It's just not that mainstream. And it feels like the business is capitalizing on the fact that it isn't that mainstream, and it is hard to invest off market in these types of businesses. And you're effectively dividing up these assets, you're making them investable almost like in a secondary market, and you're making what was formerly a really difficult asset class to invest in, apart from acquiring these businesses outright, and you're parcelizing these up so that people can get into the game. That's how it feels.
Yeah, that was a really good synopsis. You hit on a lot of good things. So I'll run through it and just stop me if you want to dive deeper. Let's talk about the why, and then we'll get into like how we're doing it. So you said, why Web Street, and where did we come from? For people that are in the e-commerce space, they've probably heard of some of the major brokerages out there like Empire Flippers and Flip and Quiet Light, et cetera, et cetera. So we are the brainchild of Empire Flippers. So one of the largest brokerages, over $500 million with a B in deals brokered, 12, 15 years now probably of experience, whatever. They've done a ton of online transactions, and we can talk about what those kinds of businesses are. I know your audience is probably somewhat familiar, but we continue to hear at Empire Flippers, I don't have the time or the money or the resources or the want to run these businesses, but I believe in them. Can I give you money and you run them for me? Can I invest in them? And we said, no, we don't do that. We're just a broker, right? After enough time, we decided to make a way to do that. And we started a separate company. It started out as Empire Flippers Capital. We shared resources at the beginning. And after we got some traction, we spun off and became Web Street, which is a standalone investment platform. We like to say micro private equity. This is not an original model. We didn't come up with it completely from scratch. There's plenty of other people doing fractional ownership of real estate, of art, of wine, of sneakers, whiskey, you name it. But there's nobody doing it for online businesses and digital assets. And I don't know about you or your audience, but we're pretty much constantly in front of the screen, right? Whether it's our phone or our computer or whatever. So anytime you're in front of the screen, somebody's getting paid, pretty much. So why not make it possible for people to invest in those types of assets? And we can talk about all the challenges. A lot of that is really, like you said, people even understanding how the businesses work. Are they actually making money? How much of their portfolio should they have in it? And yeah, I guess I'll pause there. Is there anything you want me to dig on deeper or anything I didn't answer? That's just how we started and where we're at now.
Yeah, and I guess the next immediate question that comes to mind, how do you vet these businesses? I'm friends with a few different people that invest in D2C brands and buy acquired brands, either distressed or otherwise, help to operate them, help to grow them, and look to flip them again down the track. Basically, come in, buy them, grow them, and then on-sell them. And that's their business model, and they're very good at it. It's buying and flipping houses. You buy it, you fix it up, you put in new bathrooms, you put a splash of paint, put a new roof on it, and then you flip it, and you hopefully make a margin on that arbitrage, right? And there's lots of people that do that, but it sounds like you're more investing for the long term. So you're a buy, operate, and hold business, and basically what you're doing is you're trying to bring in outside capital to not only give you a bigger capital base to invest and buy from, but also being able to defray some of that risk, but also share in that reward of the growth of those businesses that you acquire, operate, grow, and hold. And so that all kind of makes sense. Now, what are the mechanics? So let's say I had $10,000 free capital and I wanted to invest into your company. And then you're going to put that to work how you best see fit, whether you're going to aggregate that together with 10 other investors and you're going to now have $100,000 and you're going to maybe go acquire one of these businesses. First of all, how would I invest? Would I just transfer the money to your account, almost like you're a fund manager in a way, right? You're like a PE fund.
Yeah.
I would be almost like an LP in the fund. And then I would be entrusting you to make wise investments with that fund, putting money into businesses that you think you're going to be able to grow and are going to be able to continually throw off cash. And as they throw off cash in the form of effectively dividends or payouts or a profit share, for lack of a better term, because they're not public companies, they're not dividend bearing, but they are, and because they're not operated under a debt model, they're operated under an ownership model. Effectively, they're distributions of profit. And then you guys would take some of that profit and you would share that with all of your co-investors. Presumably, you're going to get the most of the carry. You're going to get most of the profit because you're expending the most time, effort, money, and risk to operate and grow these businesses. So therefore, you have to cover all operating costs and all that sort of stuff out of your carry. And then you're going to distribute any net profits left over. You're going to distribute those to your co-investors. That seems like how this would operate.
Yeah.
And so therefore, I would write you a big fat check. I'd put it into your account, and I would just entrust that you're going to go and invest this wisely on my behalf.
Sure. So you said we'd never worked with WebStreet, but you're pretty close on the model, which is awesome. So it tells me that you're well versed in investing. I want to get into the split and the breakdown and all of that and how our cash flow works, but there's a few things that make us unique that I think are important to hit on first. So one is, yes, we are essentially the fund managers. We provide the platform for you to invest in through and all of that. We do the legal setup. We help with the vetting. We distribute the cash flows, all of that. That's WebStreet. There is a third party that we haven't really hit on, which is what we call our operators or portfolio managers or their CEOs, right? Because we have such a huge network of online business operators from the Empire Flippers days, people that have bought and sold multiple businesses that are experts in Amazon FBA or experts in software as a service or whatever. We actually have a fund model. So we're on our 9th fund now. If you came to me and wanted to invest in this fund, I would show you there's these 3 operators. There could be 2, there could be 5, but let's just say there's 3 operators. One is in the Amazon FBA space, there's one in the software space, and there's one in the app space, right? And you can see their track record. And we would raise $4, $5, $6 million for this fund. And then they go out and acquire multiple businesses each. You learn what those businesses are. They are the ones operating them. Now we provide a nice ecosystem for them to have masterminds and have support and all of this stuff, but they operate. So there's really 3 parties. There's the operators, there's us, and there's the investors. So that's one thing that's pretty unique is you're investing based on these people's track records. They also invest in the deal. So if they invest 5% of the capital, so if it's a $2 million fund, they've got $100,000 of their own money in the fund, which is obviously to align incentives.
And skin in the game.
Exactly. And so after we raise the money from investors, they go out, start acquiring businesses. Any money that's not used to acquire businesses is returned to investors. We never want them to buy bad businesses. We never pressure them to. And then basically after the businesses are acquired, they migrate them, they start cash flowing. Every quarter thereafter, investors receive 2/3 of the profits in cash distribution. So this is a cash flow play. There's a lot of plays. If you buy a piece of art, it's not going to cash flow, right? It doesn't mean it's a bad investment. You're just waiting on it to appreciate.
Capital appreciation.
Exactly.
Business, not a cash flow business.
Exactly. So this is a cash flow play. Now, if the operators do their jobs and we do our jobs and grow the businesses, they're going to appreciate as well. And we sell those businesses. We sell them in the 2 to 4 year range. So this isn't a long hold period, but it's not super short either. It's an in between. We tried to hit a lot of kind of unique boxes. So that's the model. 2/3 goes to investors. 1/3 goes to WebStreet and the operators, with the operators being 23% and us being 10%. Operators don't get any salary, and neither do we, I guess you could say. If the businesses don't make money, nobody makes money. So that's the model in a nutshell. It's a lot easier to see broken down on paper, but
of course,
we work really hard to make sure each fund is diversified, right? We're not going to get you in a fund that has 3 FBA operators. And most of our investors invest in every fund or every other fund. So they're getting diversification throughout the years. And then once there's exits, they're getting their money back, and on it goes. But that's the model.
Yeah, it's a very interesting model. And I'd love to know a little bit more about how the power law affects your investment strategy. Because in the typical VC world, the power law dictates that 1 out of 10 investments are going to pop and going to do really well on average. And 9 will either do really poorly or potentially go to 0. And that one winner is going to cover all the losers and then some, and still make everybody whole and profitable at the end of the day, right? Now, the PE model is somewhat different. They still operate based on the power law, but because they are coming in and they are operating those businesses, VCs typically don't operate businesses. They act as maybe advisors, but they're providing capital, an ownership stake, usually a minority ownership stake in these businesses. They're external advisors. Maybe they have a board seat, but they do not operate the businesses they invest in. PE typically are operators. They'll come in, they'll lean them down, they'll cut them, they'll gut them, they'll cut cost out of the business, they'll fire a bunch of people, they'll take a business private, whatever it might be. You can think of all the recent PE plays in our space, and there's been a lot of them that have been taken private, and they might be SaaS businesses, they might be vendors, they might be sellers, they might be service providers, SIs, whatever it might be. They come in, they cut the gut, they get them to a place of profitability if they weren't profitable before, or extreme profitability if they were minority profitable before. Then they look within that 1 to 3 year range. They look to spin it back off and get a liquidity event for them and their funding, right? Their funders. And oftentimes that liquidity event will either be refloat on the public markets or on sell to more long-term owners and operators, right? So it feels like you're a little bit of a hybrid of these two. You're probably more like a PE than a VC, because you're not just a source of capital. You are operating these things. But is the cap table effectively like a third? Like you guys are a third, the operators are a third, and then your investors, your kind of LPs are a third. Is that kind of how the cap table works out to be broken down?
Yeah. So I think what you're saying about being a hybrid makes a lot of sense, in the sense that we're probably closer to PE, and we generally use the term micro PE just because of the size of the deals. But there is a little bit of that VC side, so I think that makes sense. As far as the actual cap tables, I don't know how they're actually written out, but it's 95% investor money, 5% of the operator's money. The other thing I would want to say, you talked about 1 popping and 9 failing. The way I can actually link the financial model for you, or anybody that wants to see it afterwards, the way we have it broken out in a fund of 5 businesses would be 1 would grow by 50%, 1 would completely fail, and then the other 3 in the middle would plus or minus 25%. Wouldn't do much, but they're still cash flowing businesses. If that model hits, which it will never be exactly that, but that's what we're basing it off of, pretty conservative, the investors will receive about 20% over the life of the fund. And we call the life of the fund 3 to 4 years. I think in the model it's 3, because we say 2 to 4. So that's a breakdown of what we're expecting out of the businesses. And some are riskier than others, right? You talked about earlier on vetting, and I don't want to go too far back in the conversation, but I know I didn't talk about it. That's another thing that's really unique, is how extreme we are on our vetting, both of the operators. They have to have a huge track record of growing businesses, but also buying and selling businesses. That's a totally different skill. Like going from 0 to 1 and 1 to 10 are totally different. And so we vet the operators big time. And then we also vet the businesses. Like we have, as WebStreet, have ultimate veto power on the businesses, and we'll find things and tell the operators, and they'll fall in love with them while they're doing their due diligence.
Of course.
And we'll have to say, look, that might work for you on a personal level, but investors' returns are the North Star here, and we're not going to take that risk. And it can be a lot of different things, right? It can be inventory if it's Amazon. It can be code base. It can be, I don't have to tell you all the things that you can find in due diligence, but that's really the value add or value proposition that you're getting out of working with us versus going to somebody directly. There are people that do this on their own. They do their own legal entities and tax forms and all that stuff. And if you want to do that, it's great, but it's not easy.
Yeah, there's a lot of mechanics behind, a lot of operational stuff behind it. Okay, cool. Two questions that immediately drop out of this process for me is, what's the source of your deal flow? Because every good VC, every good PE, they got to have a source of deal flow. And so I'm guessing, and I'm sure you correct me if I'm wrong here, Empire Flippers becomes a source of deal flow because you have early access to all the assets, the digital assets that be able to get listed on that platform. But I'm guessing that you don't constrain yourself just to the Empire Flippers network, that you could go and vet offerings on Flippa, that you could go through your private networking groups to some of your private equity groups to some of your direct to market marketing as being a serial acquirer of these brands, that you will look anywhere where you think you can keep the pipe full of opportunities for you and the operators that you potentially want to work with. It's an open door policy to looking and finding assets anywhere they might be found. First off, help me understand how you ensure consistent deal flow into the business as to where you can always be raising that next fund and have an eyeball on what might be coming next as an opportunity. And then 2, how do you think about the mix or the breakdown of the types of digital properties that you would invest in and the business models? So obviously, B2B e-commerce now is hotter than ever before. It's a decade behind B2C and D2C, but it's growing very fast. The CAGR is 8 to 10 times what B2C and D2C is. Over the next decade, it's forecast that the growth rate in B2B e-commerce is going to just absolutely be through the roof. There's so many B2B brands out there that need to modernize and need to digitalize, and they just don't even know how to do it. And it feels like there's so much growth opportunity there. It's insane. Do you focus on D2C brands, B2C brands, B2B brands, D2C brands that might need to diversify and add a strategic wholesale channel? So you need to bring in somebody that can help them do that and execute on that to de-risk their businesses. Amazon pure plays, like pure play Amazon brands. Do you have, or service providers, SaaS service providers to the space that service this space? Is there a preference for the types of businesses that you invest in, or are you almost open to any kind of digital asset play?
Yeah, two really insightful questions. So first of all, on deal flow, this is one of our biggest challenges right now. And it's for the people on our team and even outside of the team, investors that aren't in the trenches per se day to day. It's just go buy some businesses. There's all these businesses out there. It's not that easy. You want us to buy good businesses. They need to fit the acquisition criteria, both price and strategy wise, et cetera. So it's a challenge, first of all. Second of all, when we started as Empire Flippers Capital, we grew slowly on purpose, and we only purchased businesses through Empire Flippers. We knew their vetting process. We had a kind of a behind the scenes look, whatever. We were sharing resources. That's the way we started. That was also the reason we designed the company as a separate company, so that when we separated, we knew there wasn't enough deal flow through just Empire Flippers. So now we're pretty much broker agnostic. We've done deals through Flippo. We've done deals through P International, has a ton of SaaS deals, Quiet Light. We do off-market deals. If there's anybody, this is a shameless plug, anybody in your community that has deals, we're always looking. We have a whole team dedicated to it. So hopefully that answers that one, but it's a challenge. On the second one, first and foremost, we want to offer diversification. So if a pair of twin operators comes through in the same fund, we'll put one on the bench until later, because we just want to offer diversification for our investors. But as far as what types of businesses and what types of operators we're looking for, it changes constantly. When we first started 4 years ago, that was during the big Amazon aggregator boom, and it was a hot topic. People were literally throwing money at us to go purchase these businesses, and it's not that we didn't purchase any at the time, but we purchased them at high multiples. And right now we're doing the opposite. We have some Amazon operators that pure Amazon plays, like you said, that are literally buying businesses back from the biggest aggregators they just tried to roll those businesses up and not apply a specific strategy, and we're getting them.
We saw what happened with the likes of Thrasio and
that's
some
exactly
of their
it. Yeah, I wasn't going to name names, but we're in due diligence with some deals, Thrasio right now, literally at good multiples. And that doesn't mean they're bad businesses. It's just they need a specific strategy. It's not as easy as they thought. So it's constantly shifting. On the flip side, we bought a bunch of content sites that did really well, but were hit by the Google helpful content update last year, which wasn't so helpful. And we're having to implement recovery strategies and try to figure out how to turn those businesses around. SaaS is a newer one for us because Empire Flippers didn't have a bunch of SaaS and we didn't have any experts on the team, but we've changed that. And we want a mix of revenue models. Obviously, SaaS has recurring revenues. You've got churn and sticky customers and all of that stuff. So the answer is all of the above, but it's not something that we walk into blind. We're very cognizant of what's going on in the market. And the same thing happens with selling the businesses. There's a bunch of businesses right now. We've got probably 45 or 50 under our umbrella that we're currently operating. And some of our investors are saying, let's sell some, let's have some full circle. But it's like, well, we can't, exactly. But like we can, but based on what we're seeing right now, it's not the best time to sell. How about just enjoy the cash flow and we'll sell them at the right time? So there's a little bit of a trust factor. That was a long-winded answer, but I hope it covers a lot of what you were asking.
No, it absolutely does. It makes complete sense. We've seen the IPO market all but come to a screeching halt over the last couple of years, and it's the same with the secondary market for resale for digital assets, just as the same as it is in the public markets. Deal flow is slow right now. There's no question about that. And if you've got a solid cash flowing business, why would you sell into a weak market when you can sell into a hot market instead, especially if that business is cash?
That's right. And it's not just slow in digital assets. We're having a lot of investors that are like syndicators for real estate that are coming to us because they don't have the deal flow in the real estate side, and they've got people, their investor base is trying to invest. And so we're seeing that. I don't know if it's across the board, but it's in a lot of different sectors.
Yeah, deal flow is definitely slowed to a crawl. I think almost across most asset classes that don't start with the name AI or
That's right.
don't start with the two letters AI in them. I think that sector is about as hot as it gets right now, and that's where it seems like most of the capital is flowing.
That's funny you met very quickly, because one of the software businesses we just purchased, it was about $2.5 million. One of our larger acquisitions, it was a .ai product. And
Why doesn't that surprise
yeah,
me?
exactly. So
Yeah, good stuff. Good stuff. And when you think about where you ultimately would like this business to get to, I know you're continually opening new funds, raising new funds. First of all, do you only invest in businesses that are found in the United States, or are you North America, Europe? Are you global? Where do you operate? Where are your target market? Two, where do you see this business getting to in, say, the next 5 years? Perfect world scenario. Do you see it? Do you see just the individual fund sizes that you raise getting bigger, the acquisition targets getting bigger, the multiples that you're prepared to pay or can pay getting higher? What do you see as, because very few funds or very few investment pools stay exactly as they were when they were founded. They have to evolve with the market. As the market evolves, they got to adapt. And so you'll see a lot of VCs start to dabble in PE and vice versa. You'll see some VCs taking a more active role in these businesses during the low periods, whereas in the high periods, they take much more of a hands-off approach, where they maybe didn't require, during the high periods, they didn't require a seat on the board, whereas during the low periods, man, we're going to have one or two seats on the board for that 20% that was stake that we're going to take in the business. So they have to adapt to the market conditions and what the opportunities look like and what the current multiples are in the market for their specific vertical or category or sector. And I'm guessing you have to adapt too. So first of all, where are you targeting geographically at the moment? And two, where do you see yourselves having to adapt to continue to grow as a business moving over the next 2 to 5 years?
sure. Yeah, you're 100% accurate with needing to adapt. Geographically, one of the things that was really cool about Empire Flippers and our Web Street team is we've been remote globally forever, before COVID, before all of that. Now that's our team, obviously, but I say that to say that the internet is the internet. So we have investors and operators and businesses from all over. One of the cool things about our team, just to linger on that for a minute, is just off the top of my head, I'm here in America. We have Portugal, Egypt, Thailand, South America, Mexico, a few other Americans. So it's a really cool, culturally diverse team. And that allows us to be pretty flexible in the conferences that we go to and the operators that we find and all of that. Foreign investors bring a whole nother bag of worms as far as the taxes and that type of thing, but we welcome them with open arms. So that we really think just gives us a lot more opportunity to find the best deals and find the best operators, to not be geographically limited. So that's the first part. The second part is, I don't have a crystal ball, but we are constantly evaluating what it's going to take for us to be successful as a company. What we've determined, for round numbers, that we need and that we see out there in the current landscape, and it's going to continue to change, is we feel that we can do about $100 million in businesses, in cash deployed per year in businesses. So that's the number. The investor side of things is pretty tricky. We're having a lot more institutional type investors come to us right now, just because of what you said earlier. They don't have places to put their money. We like that. Obviously, it's easier to take bigger checks than a bunch of smaller checks, but we also never want to get away from what our vision was, what we set out to do. We want to make this an asset class that's available, a new basically asset class, or a new part of an alternative investment asset class, and give access to more or less anybody that wants access to it, that has the means. And we want to be able to let these operators run the businesses the way they want to run them if they need help, but we don't want to give up control unnecessarily. So it's always striking a balance. We're definitely entertaining some more institutional investor type money right now. And I think that's the way we'll continue to shift, but we always want there to be a piece of the pie for individual investors. And we have a lot of individual investors who will pool money with their friends as well and do their own LLC and invest through that.
Almost like syndicate.
Exactly. I don't know is the short answer, but it's something that's the best answer I can give right now. And 2 years from now, it could be completely different.
Makes complete sense. And do you see a point in the future, and I understand the whole wanting to democratize access to this asset class, which is the whole goal behind it and why it was set up and what its vision was. Do you see an opportunity in the future where you could potentially have a public ETF as spin one of your funds off and spin that up as an ETF, or combine multiple funds and spin that off as an ETF, as a liquidity event, and make that open to, because obviously the one benefit of being listed on a major stock exchange is the fact that you have access to a much broader investment pool, right? In almost every major regional brokerage in every country in the world will allow you to access, for example, ETFs on the New York Stock Exchange, for example. And so it just makes it easier in some respects for international investors, however big or small, to be able to invest in your fund when it's on a major exchange. So do you see that as ever being of interest to you guys, or do you think, nah, that's really going down pretty much the whole retail investor route, and that's not really where we want to target our funds?
It's definitely something we've talked about. I would say we're open to it for sure, but it's not something that we've done too seriously. On like a similar but different note, we've also toyed with the crowdfunding model, right? Allowing people to get in for a much lower minimum, but have maybe annual distributions instead of quarterly or whatever, just some different terms. So we played with that as well with mixed success. So the answer is yes, we're definitely open to it. It just depends. We try to keep our team really lean team of A players. And anytime you add these nuances, it just adds more complexity and
compliance,
exactly,
and legal costs, merchant banking costs, all that sort of
exactly.
stuff.
But one of the things I'm really proud of that we do is we are really open to testing things. We'll test them, and if they work, great. If not, then we'll just move on quickly. But sometimes that's easier said than done, and you'll waste a lot of resources testing something, or you'll test it for not long enough and you were just ready to knock the door down and you pulled the plug. It's a checks and balances, but yeah, that's something we've definitely talked about.
Right. And so presumably you've got an internal team that helps to vet these opportunities for viability, checking the founder's background, I guess the legal, the corporate structure, the ownership structure, their P&L. Basically, you're going to be looking at maybe even looking at their tax returns to make sure that what they say is their EBITDA is actually their EBITDA, all that sort of stuff, right? There's nothing like a tax return to prove whether what somebody says about their business is true or not, right? What they say to Uncle Sam is usually hopefully the most accurate version of what their business is actually doing. And so you have an internal team that helps with this vetting process, helps with the background checking process, but then you also bring in the potential operators of those businesses to help with the vetting process as well, right?
That's exactly right. And sometimes they'll find things that we don't, and sometimes it's the other. It's rare that we do this, but there are some agencies that specialize in certain types of business vetting that we'll bring in if we're unsure. But yeah, tax returns, background checks, referrals, talking to brokerages they've worked with. One of our core tenets is don't do business with assholes. And it doesn't mean that they could be an awesome business person, but life's too short and we're just not going to do it. So if we see those red flags, we just shake hands and move on. One of our team members was he was on the vetting team for Empire Flippers. So he would about 95%, this used to be true, I'm not sure if it still is, but they get a lot of businesses submitted to their marketplace. About 95% would be turned away just because they didn't have a long enough track record or like whatever. They wanted the best of the best. He was on that team that would vet the businesses and decide what got put on the marketplace. So we were really excited when he wanted to switch gears and come with us. So he's been an asset. Yeah, I'll give you one example too. Then this was one of our operators that found this on an Amazon business. I can't remember all the details, but essentially he found where the seller was lying or covering up their shipping model. They said they were doing X amount by sea and with very little by air or vice versa, and it was all a lot of it was in Chinese, so it was very hard to figure out. And he actually dug deep enough. I think he got some outside help and determined that they were basically covering up costs in shipping, and that was a huge risk. And so we were able to negotiate that deal down big time, which was a big win.
Wow. Yeah. So you still acquired it, but you had more leverage when you went to the negotiating table because of the due diligence that you had done on their freight and logistics costs, basically.
That's exactly right. Now that's a rare case. Usually when we find something like that, it goes the other way. But that one we did acquire. We had a software one recently that we backed out of once the operator got deep into the code base and realized like, hey, AI is going to replace this in the next 5 years. This is just not something I feel comfortable acquiring. It goes both ways.
Wow. And is there anything that's a green flag that you go in and you go like almost basically, this appears on the surface of it to be such a great opportunity that basically unless some weird red flag comes out of the woodwork during due diligence, this is almost an automatic yes for us.
Yeah.
What are the types of deals that feel like the Goldilocks deals where you go, this is just perfect for us?
Yeah, there's a few things. We always want businesses to be trending in the right direction. That sounds really obvious when you say that, but like you can get good deals on businesses that are declining. We just don't want to do that. We just don't want to tell investors like we bought this declining deal. Maybe we can turn around, maybe we couldn't. A few things that we really is we don't want the founder to be super tied to the business to be super dependent on the founder, which is very common. And if that's the case, then we want the founder to stay on and help in some capacity for 6 months or a year. So that's usually, if they're willing to do that and they care about their brand that much, that's usually a pretty big green flag for us. The fit to the actual operator is the biggest thing by far. We have one that we discussed today on our investment committee where it's about a $900,000 business. It's in the cybersecurity niche. This operator of ours, his whole track record, his whole background is in cybersecurity. That's a big green flag, right? It sounds obvious, but like those are diamond or needle in a haystack type finds. In FBA, we used to look at the amount of SKUs that they had, right? If they had, but only one of them was propping the business up, that's a huge risk. Same thing for the SaaS businesses. Are they dependent on one huge corporate customer that might just switch? That's a red flag. But on the flip side, if it's a well-diversified blend of customers that doesn't have a lot of churn, green flags. So those are some examples. There's a bunch more, but hopefully that's helpful.
Love it. Love it. And if you were to say over the next 12 months, just looking 12 months into the future, what are the priorities for the business over the next 12 months? Because we're going into a period of market uncertainty where the stock market is at all-time highs right now. So who knows whether that will continue or not. I always stay fully invested at all times. So I don't jump in and out of the market. I don't try to time the market. I'm a big believer that time in the market will trump time in the market every single day of the week and twice on Sundays. I'm not gonna outplay the algos. I'm not gonna outplay the high frequency traders and all that sort of stuff. So I'll never be a day trader. I'll never be a short-term trader. I'm a long-term buy and hold investor in all of my investments. They're long-term. So for you guys, knowing obviously with the US elections coming up, a lot of uncertainty there. Elections just happened here in Mexico, first woman president ever in the history of the country. Lots of political change happening all over the world, lots of market uncertainty, lots of inflation still out there. The market wondering, geez, okay, the Fed just dropped interest rates by 50 basis points. Is that going to reignite inflation? Are they going to have to raise them again in a quarter? So there's a lot of uncertainty out there. I guess there's always a level of uncertainty in investing. There's no such thing as a sure thing. Otherwise, everybody would be in that sure thing. For you guys, as you look out over the next 12 months or less, 6 to 12 months, what are some of the things you guys are doing to position yourself for success regardless of kind of what the public markets do over the next 12 months?
Sure. Yeah, you're spot on again. I know everybody's tired of hearing it, but the election season matters. People are nervous and rightfully so. We want to continue to deliver strong returns. Right now, we're around 3%. Depending on which fund you're in, across all 8 funds or so that are cash flowing, we're around that 3% quarterly, which is really solid. That's without any exits. So we want to continue to hit those, even with AI updates, even with Google updates. Some of that's out of your control, like on the business we purchased. So we don't want to lose sleep over that. If the other thing is deal flow, we hit on that a good bit, but like deal flow is a challenge, good deal flow. So working really hard on that. As WebStreet, as a brand, as a company, selfishly, really expanding our brand. Like we've grown slowly on purpose. We wanted to get the systems in place. We take pride in getting our K1s out on time. We wanted to build the company the right way and not be scrambling. But we're past that point now and it's time to scale a bit. But we want to continue to scale the right way. And it's a huge challenge to market to the right people. We don't want Timmy's college fund, and we don't want somebody's last dollar. This needs to be a small percentage of your portfolio. So we need to market to the right people. And then we really need to educate, because I think based on the questions you're asking and what I've heard on your podcast before, some of this might sound elementary, but a lot of people really don't understand online businesses and how all of this works. And sure, we'll take your money if it's a good fit and you meet the requirements, but we really want you to be educated about what you're getting into. It's going to be a more enjoyable experience when things are going well. And then you're going to understand when things aren't going well, and you're going to be less frustrated. So those are some of the challenges over the next year, I think is what you asked. But it's a little bit of hold right now. It's almost October while we're interviewing. So we're getting close. Let's get past the election.
And then there's one thing I've learned over public market investing over a very long period of time is that the market just hates uncertainty. They don't necessarily mind who gets elected or whatever, but they just don't like the uncertainty. And they're like, a lot of businesses are just in a holding pattern right now until that election happens. And they're like, okay, if Kamala gets elected, most likely we're going to go down more of a socialist path in the United States. And if Trump gets elected, then a less socialist path, most likely. At least businesses can make some plans once they know what is going to happen and what's likely to change from a policy perspective, from a taxation perspective, etc. But it's really hard to make plans when you don't know what's next.
It affects everything, right? We talked about deal flow ad nauseum, but if you're selling a business right now, do you want to be? Maybe you do. Maybe you want to get it done. I don't know. If you're selling a house right now, do you want to just uncertainty to your point? So I understand where people are at.
Yeah, and I guess just the housing market frozen up because there's a lot of people still on 2% rates,
Right.
and while rates are elevated, they're not gonna sell their house and acquire another house at 2-3 times their existing interest rate. So it puts the big freeze. Some people have to move if they have to move for a job or something like that, and they have to sell. But for people that don't have to sell, that puts a real chilling effect on the market. We want the market to be a little bit looser. We want the market to be a little more transactional. We need some momentum. We need some throughput in the market. So yeah, I'm sure that you're looking forward to the election being in the rearview mirror, and at least everybody knows what's ahead.
That's exactly right. Yeah, I get it. Even if interest rates should be at, you could argue what they should be at, but if they should be at 6 or 7, it still takes a psychological hit to go from 2 or 3 to 7 or 8.
Yes, especially since post 08, the ZERP era was so long and so deep, and everybody got used to free money that it's now the Fed's slowly taking the punch bowl away. You could argue they took it away too late, but like you said, it's a psychological readjustment and it's a valuation readjustment for a lot of these brands. And it's hard for these owners to go, in this interest rate environment, my business is probably not worth as much, right? Because the cost of capital is higher. And therefore, and a lot of these business owners, they didn't know how to value their business during peak times, and they definitely don't know how to value their business in a contracting market. So I guess there's probably a lot of education on your part as part of even the acquisition process or the negotiation to acquire process. There must be a lot of negotiation or education that has to go on with those sellers of those businesses to help educate them on what kind of multiple they should be expecting to get for their business in the current environment.
That's exactly it. And it's every seller's, every founder's, their business is their baby. And I get it, but it's worth what it's worth based on the market at the time. Now, one thing, I don't want to go too far down the weeds here. I know we're getting close on time, but one thing I didn't hit on that we really put a lot of work into is deal structure, both to get a better deal, because we've got the money in hand, right? We're not coming and trying to finance these deals or anything like that. So we've got some leverage on that perspective. Like we can wire you the money tomorrow or the next day. So that gives you some leverage. But we also want to protect the downside of our investors. So we do a lot of like earnouts and things like stabilization payments and things like that to get better deals. A lot of people don't even know that's an option. And I don't say that as like holier than thou, but like deal structure matters and limiting downside for investors matters. Getting those stability payments, getting the founder to stay involved, whatever the case is. I've seen some really creative ones where it's like, all right, if these top 3 customers, you get X% of these top 3 customers, and then you get a smaller percent or nothing of the rest. And so you're betting on your operator getting new customers in the door, whatever the case is. I'm rambling a little bit, but does that make sense?
Totally. And I learned this from Cody Sanchez as well. She came up with this saying that I thought was absolutely genius. When she goes into negotiations, she says she'll tell the seller, you can set the price or you can set the terms, but you can't set both. You name your price, and I might not negotiate on the price at all, but I'll set the terms of the deal. Or you can set the terms of the deal, and then I'll tell you what I'm prepared to pay for those terms. And that's such an interesting way of looking at it, which is it's like when you work in the e-commerce space, and you maybe work in the agency space, the consulting space, or whatever, and you're trying to put a project together for a client, and you say, look, there's the scope, there's the cost, and there's the timeline, right? You can dictate 2 of those, but you can't dictate all 3. And pick your top 2 most important elements of this triangle. So I love that. I love that. Now, listen, as we do come down to the end of our time together, this has been a really enjoyable conversation. I've learned a lot. This is a space that I am not the guru in this space. You are. So I really appreciate you sharing your knowledge with me and my audience as a guest mentor. We're now coming down to the end where I get to flip the script. I get to hand the microphone over to you. I get to let you ask me one question. Any question you like, can be personal or professional. Kyle KUDEREWSKI from WebStreet, what is your question for me today?
I like it. I like it a lot. Okay, so we talked about a bunch of the different alternative investment classes out there, the different types of alternative investments. So let's take real estate out and let's take online businesses out. You've got $100,000 right now. What type of alternative investment are you investing in?
Man, that is such a good question. Oh man,
And the answer should be I'm going to split it up. I know that, but I'm going to make it hard.
Yeah, of course I'm going to split it up. But I think I am so bullish, and it's probably because I work so heavily in this space now, but I am really bullish on B2B e-commerce. Yeah. I really am. And I think that a lot of these B2B brands that need to modernize, that are second and third generation family-owned B2B businesses, because that most of the clients that I consult to in the B2B world, they are family businesses. They're second and third, they're 50, 75-year-old B2B brands that the child or the grandchild of the founders now is running the business. They need to modernize. They don't necessarily know how. They're getting a lot of pushback from the elders in the business and the board, et cetera. And I tell you, these brands, once the elders move out of the business and out of active leadership of the business, these young guns who are digital natives, who are taking over these businesses, are going to actually just light these businesses on fire. They are going to explode. And I think they will infuse digital capabilities into these businesses at a great rate of knots. They'll figure it out. And it's going to bring these old school businesses into the new era. And we know that the data shows that in America, over 60% of B2B buyers today are now millennials. So they expect a digital buying experience. They don't expect a legacy buying experience. They don't expect to carrier pigeon and email and fax and dealing with their sales rep. They expect to be able to log in. They expect to be able to do the transaction. They expect EDI to be available. They expect e-procurement to be available. They expect these digital channels just to work and to be available because they're buying as part of their job. They're not buying for pleasure. They're not buying because they've been inspired. They're not buying to be aspirational or to build their personal brand. They're buying as part of their day job, and they want to get in, complete the transaction, and get the hell out and get on to the next job as fast as they possibly can. And I think I'd be looking for as many legacy B2B businesses as I possibly could that haven't yet modernized, and put them basically through a digital boot camp and re-envisage their businesses. That's where I would be looking to invest.
Yeah, no pushback from me there. I think that's excellent. I think you're spot on. You can get as complex as you want with it, but a lot of them don't have any digitalization. Like, just start with some Zapier integrations and let's just start there, and you can
simple stuff, right?
Yeah.
Simple to us, simple to people like us, right. But it's not simple to them. It's a whole entire. It's not. I like to say it's not just a mindset shift; it's a heart set shift. Yeah. Because these people, they're very emotionally connected to their businesses, because it's especially these family businesses. They've been doing the same thing the same way for more than one generation. They're in love with their businesses, and they're in love with the way they've always done things. And that's a really dangerous place to get to as a business, where you're too in love with how you've done things forever, and therefore it's really scary to even contemplate change at that scale. So yeah, that's why I love working in this space too, because holding their hands through that and giving them confidence that the next step is the right step, and helping them build the business case for digital investment, that stuff is super rewarding, super exciting times. Now, Kyle, how do you like people to get a hold of you? I'll drop a link to your website in the show notes and to your LinkedIn profile in the show notes. Other than that, if people want to reach out to you and they want to learn more about what you do, how you do it, or are thinking of investing in this asset class through you or through anybody else, how do you like people to get a hold of you?
Sure. Yeah. So just to reiterate, the website is webstreet.co, not .com. So I know you'll put it on there. And my email is kyle@webstreet.co. Totally. Those are both good. The LinkedIn is probably the best. I'm super active on there. If you're interested in investing, go visit our site and just get educated, and then reach out to us. We have an investor relations team that is really responsive. You schedule a 15-minute call. This is not a sales call. This is hey, is this a fit for your portfolio? What questions do you have? Call. So worst case, you waste 15 minutes and you learn a little bit more about what we're doing. So those are the places, and I look forward to hearing from the audience. Really good conversation, man. I appreciate it.
If you'd like to get mentored by Jason for free, head over to greenwoodconsulting.net, scroll to the bottom of the page, and click Get Mentored by Jason.